The market is on edge. U.S. stock futures showed a slight dip on Thursday night, a direct response to the previous day's sell-off. The core issue? Rising concerns about the lending practices of regional banks. This has investors worried, and it's easy to see why. Let's break down what's happening. Futures tied to the Dow Jones Industrial Average fell by 102 points, or 0.2%. The S&P futures and NASDAQ 100 futures also saw declines, both dropping by more than 0.3%. In after-hours trading, the market reaction continued. Interactive Brokers Group saw a drop of over 2%, despite reporting strong quarterly results. Oracle, the cloud computing giant, also slipped more than 2% after sharing its long-term financial outlook with analysts. Even drug makers Eli Lilly and Novo Nordisk experienced a downturn, influenced by President Donald Trump's comments about negotiating lower prices for their obesity drugs during a briefing on fertility treatments. Wednesday's trading session painted a similar picture, with all major U.S. stock indexes closing in the red. The Dow lost 301.07 points, or 0.7%. The S&P 500 and the NASDAQ Composite fell by 0.6% and 0.5% respectively. But here's where it gets controversial. Shares of several financial heavyweights and regional banking names took a hit after Zions and Western Alliance disclosed problems with bad loans. This sparked fears about loose lending practices and the potential for similar issues elsewhere. The SPDR-SP Regional Banking ETF, KRE, which has been declining for 4 weeks straight, lost more than 6% during the session. The recent bankruptcies of 2 auto industry-related companies have only added to the unease in the banking sector. Wednesday also saw a jump in the CBO Volatility Index, VIX, often called Wall Street's fear gauge. At the same time, Treasury yields and the U.S. dollar moved lower. Gold prices, however, rose to new records, suggesting continued interest in the safe haven asset amidst all the uncertainty. Liz Ann Saunders, chief investment strategist at Charles Schwab, noted on CNBC's Closing Bell that the banking concerns come as there's a lot of speculative froth in the public market. Investors are chasing riskier stocks, like those in quantum computing, drones, and unprofitable tech. When you have that speculative froth, and then you have sort of a bigger picture potential issue, those two can sometimes collide and cause an increase in volatility, she said. She also noted that the froth is no longer concentrated in the mega-cap stocks, but rather in smaller pockets of the market, such as the Russell 2000 index, which hit a new high on Wednesday. Meanwhile, other factors continue to weigh on the market. These include tensions around global trade and tariff policies, high market valuations due to the artificial intelligence boom, and the ongoing U.S. government shutdown, now in its 3rd week, which has halted the release of crucial economic data. And this is the part most people miss. Despite the recent downturn, the S&P 500 is still up nearly 1.2% this week, thanks to a strong start to the 3rd quarter earnings season. The Dow Jones Industrial Average has added about 1% week to date, while the NASDAQ Composite has gained 1.6%. Here's a quick look at some companies making headlines in after-hours trading. CSX Corporation. Shares of the railroad jumped 2% following strong quarterly results, beating analyst expectations. Interactive Brokers Group. The stock fell nearly 3% despite exceeding earnings and revenue forecasts. Oracle. The cloud infrastructure provider's shares fell 2.4% in after-hours trading after providing its long-term financial outlook. What do you think? Are the concerns about regional banks justified? Do you see any opportunities in the current market volatility? Share your thoughts in the comments below.